Talk about the inherent limitations of auditing. When I say inherent limitations of auditing, uh, the auditor is not able to reduce the audit risk to zero. He is unable to obtain the absolute assurance. The auditor can provide reasonable assurance but not an absolute assurance, and to ensure that whether the financial statements are free from material misstatement due to fraud or error. He may give a reasonable assurance. So in such case, what is the reason for inherent limitations of auditing? The first inherent limitation is the nature of financial reporting. The financial reporting involves preparation of financial statement. Now, whenever financial statements are being prepared, it involves a lot of judgment, and it involves what you can say subjective decisions, and also there may be what you can say degree of uncertainty because of subjective judgment and degree of uncertainty. So it is not possible for the auditor to provide a absolute assurance that the financial statements are free from material misstatement due to fraud or error. So take example, that is a degree of subjectivity in case of provision for expected credit loss or provision for bad and doubtful debts. You cannot tell by accuracy. That's the real challenge. So any accounting estimates, for that matter, say provisions, contingent liability, it involves a lot of subjective decisions and a lot of degree of uncertainty, and that is why you cannot highlight the same thing. And one of the premise of conducting the audit is that the management is responsible for preparation of financial statement as per applicable financial reporting framework. The management design, implements, maintains the internal control. Now, control over financial reporting may not function as required. It may not produce the results. It may not operate in a manner, and it may not produce a reliable financial information, and because of its limitations. So one of the examples which they highlight is that, so take example, purchases are being made. When the purchases are being made, what happens here? The goods received section, they'll put a stamp that the goods have been received. Now we have to make the payment of only those goods which is actually received. The vendor may submit 10 bills, but out of that 9 bills has got a stamp that goods actually has been received. Then you make payment only for those 9 stamps. You don't make payment for the other balance bill. So that is a control. But suppose if there is a collusion between the account and the goods receiving section person, they collude to override the control, where they just put a stamp even though goods is not received. Then in such case, what will happen? The system will fail. The control will not produce a reliable financial information. Okay. So ultimately, one of the objective of control is that it produces a reliable financial information. If it does not do that, then definitely the control fails. Okay. So with this, I'll move forward, soldiers. This is one of the limitation, that is nature of financial reporting. Why as to the audit risk cannot be reduced to zero.